Welcome back. Over the past 3 videos, you've learned how secondary market annuities work, why they're safe, and you've met some real customers with real success stories. Today, I want to show you the math that makes this possible. I'm going to prove to you with actual numbers that you can verify it for yourself how this strategy beats both the traditional Wall Street advice and it beats complex annuity products. This isn't theory, and this isn't a sales pitch, it's just math. Math doesn't lie. So let's start with what Wall Street tells you to do. You've probably heard this advice 1,000 times. Put 60% of your money in stocks and 40% in bonds. Take out 4% per year for your living expenses. Hope it lasts. Well, let's see what actually happens with a $1 million portfolio and a need for $40,000 a year of income. Using historical market data and Monte Carlo simulations, the same tools that financial advisors use, here's what happens over 25 years. In the middle of the road scenario, you end up with about $2.4 million of final account value after 25 years of taking inflation-adjusted withdrawals. Not bad, right? But here's the problem. You're gambling with your grocery money the entire time. Oh, and by the way, I didn't even factor in money management fees. Just saying. What Wall Street doesn't tell you is that you're exposed to a whole host of risks in this 60-40, 4% withdrawal rate scenario. You're exposed to sequence of returns risk. If the market crashes in the first few years of retirement, your portfolio might not recover and it won't support you and your required spending. You're also exposed to reverse dollar cost averaging risk. And that means instead of buying more shares when the market is down, you're selling shares when the market's down to pay for groceries. It's the reverse of dollar cost averaging when you're investing over time, which usually works out in your favor. When you're drawing down systematically over time, it kills you. These risks compound, magnify, and enhance each other. And most people are just blindly following this terrible advice. In a worst-case scenario, that $1 million portfolio could be completely depleted in 15 or 20 years. That's the dirty secret that Wall Street really doesn't want you to know. Wall Street doesn't deal in guarantees. Now, let me show you a completely different approach. Instead of putting all your money at risk, what if you bought the lowest priced guaranteed income, covered what you need, and invested the difference for growth? Kind of like buying term and investing the difference. People talk about that in life insurance. Well, I'm doing it in income insurance. So instead of doing the 60-40 stock bond advice and carrying all the risk, what if instead you bought the income you needed to make that 4% withdrawal, got it guaranteed, and invested the difference, the savings plus your unused principal, and invest the difference, the savings plus the unused principal, in the market for growth. This way, your downside's covered, guaranteed. You've got all the income you were looking for. You can put all your assets on growth outside of that income allocation because your portfolio doesn't have a withdrawal rate risk and it doesn't have market timing or sequence or any of those other risks. Here's what it looks like when you buy your income. In this case, a 25-year, $3,333 a month guaranteed payment stream at a 6% yield. That costs $521,566. That leaves $478,434 left over to invest in growth. I use the same portfolio projection settings as in the prior example, which is a low-cost index fund. But when you remove the withdrawal rate pressure from the portfolio, the growth is astounding. Using secondary market annuities as the backbone of your retirement income plan, you could end up with an amazing 81% more total financial output, an ending portfolio balance of $4.4 million. Who says guaranteed annuities are boring? Some pretty amazing financial results here. Now, I've got some much more detailed videos on this concept, which walk you through step by step how to go through this, how to do the illustrations for yourself. But for now, let's look at a real example from our current inventory that fits this kind of situation. Here are 3 immediate income, 25-year payment streams. This is taken right from our current inventory page. If you're looking to build a portfolio of guaranteed income to give stability like I just talked about, this is the type of thing you should be buying. Remember, these will pay exactly as stated. Here's MetLife, paying 308 monthly payments of $2,815.41, starting October 1st and lasting until May 1st of 2051. Or Prudential, starting at $800 a month and then stepping up to $1,238 per month, with an additional 3% cost of living adjustment, stepping it up every year. This works so much better for 3 reasons. First, like I said, you eliminate all the major retirement risks. sequence of returns and withdrawal rate risk. There's no sequence of return risk here because your income is guaranteed. There's no withdrawal rate risk because you're not taking withdrawals from your growth assets. The second main thing is that your growth assets can actually grow. When you're not forced to take money out of them for living expenses, your investments can ride out market downturns and rocket up with long-term compounding on those bull runs without you having to drain them for grocery money. Third, when you get wholesale pricing on your guaranteed income, you can have even more invested for growth. So instead of paying retail prices for a new annuity, you're buying an existing payment stream at a discount and giving yourself more room to grow with your remainder assets. Now, let's talk about why this beats traditional annuities. Traditional annuities are kind of black boxes. Even the agents selling them don't understand how the returns are calculated. Well, if the S&P goes up 10% and your participation rate is 40% and the cap is 6, then you get, well, I got to call the home office. I mean, I can't figure them out. Plus, with these things, you're typically paying for annual fees of 1, maybe 2%, 7 to 15-year surrender charges, complex riders, marketing costs. You need a PhD to understand some of this stuff. Secondary market annuities are the exact opposite. I think of them as annuities for smart people. The payment schedule is downloadable, verifiable, and plain as day. The yield calculation uses basic discounted cash flow math. The insurance company backing it is clearly identified. There are no ongoing fees. There's no surrender charges, and what you see is what you get. $1,700 a month for 30 years means exactly $1,700 a month for 30 years. Let me show you a real comparison using current market rates here. A traditional immediate annuity paying $1,000 a month for 20 years, well, that's going to cost about $152,984. That's a 4.9% yield on a 20-year income stream. These are current market rates, but they do vary with time, and rates are coming down, which pushes prices up. Now, a secondary market annuity from the same insurance company at a 6% yield for the exact same 20-year payment stream of $1,000 a month, 1.1% higher yield, $11,599 lower price. That's a big savings that you can put in your pocket, that you can invest for growth, that can really make a giant difference over time in your financial portfolio. Here's kind of my favorite test for a financial product. Can an engineer understand it? Engineers like things that are logical, verifiable, and transparent. They don't like black boxes. I have dozens of engineer customers because secondary market annuities pass the engineering test. The math is basic DCF or discounted cash flow math that anyone can verify. That 25-year payment stream, click the current inventory button. See it on the web. The payment schedule is downloadable right there. Click the green More Info button and you can download it. You want to check my work? There's a calculator right on the website. Plug the numbers in there and you can see the exact same results. Plug them into your financial calculator. Put them into Excel. I don't care. The internal rate of return is exactly what I said it is. You'll get the same results with any financial calculator. The insurance company backing the payments is shown right there. The legal structure is documented and transparent. As for that buy term and invest the difference strategy I was talking about, I use the same Monte Carlo simulation tools called Portfolio Visualizer. Like I said, I've got some longer videos about how to do this, and you can run all those numbers yourself. You can verify all this stuff. Try giving an indexed annuity contract to an engineer and asking them to verify it. They're going to hand it back to you and say, this is incomprehensible. The bottom line here is that anytime you do an apples-to-apples comparison, secondary market annuities offer more payout at a lower cost, and they have a higher yield. Same starting amount, same income needs, same time frame, just lower price. When you put that into a portfolio, this completely revolutionizes the outcome. You get dramatically better results. But here's something important. We're kind of in a unique window of opportunity, one of the best environments for this strategy I've seen in a decade in this industry. Interest rates have been high for a couple of years now, but there is massive political pressure to cut rates. I can still offer payment streams at 6% plus, yields that would have been 3, maybe 4% just 2 years ago. And they might be 3 to 4% yields in a year or two. We are at a high point, maybe even an inflection point in rates. And that means lower prices for the same income right now. Lower prices mean more money left over for growth. But this opportunity won't last. As rates go down, when the Fed cuts those rates, yields will go down, prices will go up. It's just basic math. Traditional annuities are often sold using fear tactics and high-pressure sales because they need to overcome the complexity and the poor value proposition of the annuity itself. I don't have to sell that way because, well, the math speaks for itself. Higher yields come with complete transparency with secondary annuities. There are no surrender charges or complex fees. You have verifiable with basic financial calculations. When you've got a genuinely superior product, you really don't need pressure tactics. So really, that's it. There you have it. The simple math that we did in this video beats the Wall Street advice and traditional annuities. 81% more money than the 60-40 approach with lower risk. 1% higher yield than a traditional annuity with complete transparency. These are guaranteed outcomes that you can verify for yourself. So in the next video, I'm going to help you evaluate whether this makes sense for your specific situation. I'm going to give you the exact framework to determine if you're a good fit, and then what to expect if we do decide to work together. Because here's the thing, this really isn't for everyone, and I'd rather have no transaction at all than a bad transaction. So thanks for watching. I'll see you in the next video.